All right, now Wall Street is getting more bullish on stocks, partly because of that story. Goldman Sachs boosted its year-end forecast for the S&P 500 to 1060 today. The only forecast more bullish is that of Tom Lee, the chief U.S. strategist at JPMorgan Chase. His forecast is for the S&P 500 to hit 1100 by year-end, and that is because of earnings, because of the emerging markets outlook. He joins us now from his firm in New York to tell us why. Tom, thanks for coming on the show.
Hey, Matt.
Let me first ask you, it's really earnings, isn't it? And because of the emerging markets or the companies that work abroad that you're so bullish.
That's right. We've been looking at the second half recovery and really a 4 to 6 quarter recovery globally to be one that's really emerging markets focused and very smokestack intensive. One that's going to involve a big move in global industrial production.
Well, why do you think that we're going to see that? I mean, why are you more positive, for example, on the emerging markets economies or chances than you are of those here in the U.S.?
Well, first of all, the good news is, it's actually taking place. In the second quarter, the emerging markets on a real GDP basis grew about 4%, 4 to 6% actually when the final numbers come in. Those economies don't have a balance sheet recession underway. They've been able to really respond to fiscal stimulus. And when you look at the domestic final sales drivers, whether it's electricity consumption or auto sales, they're really, really taking off. So, I mean, there's a real recovery there.
But that recovery isn't going to help companies that don't work, obviously, with the emerging markets, that don't sell things abroad, that don't have units abroad. I mean, what do you think about the companies that are based here in the U.S. and get their revenue from here in the U.S.?
Well, that's probably what makes this recovery a little different. It's going to be less dependent on a U.S. consumer driver. But you have to remember, if global production ramps up, and let's say in the Americas it's 10%, 40% of all the jobs lost in this recession have been manufacturing. So you're going to see manufacturers start to hire again. That's going to help stabilize consumption. So there is going to be a trickle-down effect to the U.S. economy overall.
What do you think about the job losses? I mean, when will we get back to normal levels, or will we ever? Is jobless recovery the new normal as far as we're coming out of recessions from now on?
Well, almost every recovery is initially viewed as a jobless recovery. That's because employment lags. We do think unemployment claims will actually dip below 500,000 sometime this quarter. So in the next 3 months, we're going to start to get some pretty decent signals on the labor market.
And when do we start adding to jobs again? Not until next year?
Yeah, I think it's, businesses have to gain confidence, so they're going to have to see rising orders. They're going to be running more shifts, so you're going to see hours worked actually start to increase. And then, of course, finally, it's going to lead to people hiring. So I think you're going to have a progression. But as claims fall, I think you're going to see the hiring sometime in the first quarter.
We are, though, seeing rising revenues, as you point out, sequentially. So it's not just that earnings are picking up because people are firing all their workers and boosting the bottom line, right? The top line is actually starting to recover.
That's exactly right. I think as I've heard people talk about the quarter, I think they're really missing something big. Revenues sequentially can't rise if the global economy is shrinking. And 2/3 of companies are reporting higher sequential revenues. And that really is evidence that when you look at nominal GDP, the emerging markets is growing enough to boost overall GDP growth 1% this quarter. And the fact that 2/3 of companies have rising sequential revenues really supports that.
Well, you do see, obviously, markets discounting this improvement. And as we point out, Goldman Sachs, just one more sort of getting on the bandwagon today. They're slowly catching up, other analysts, other strategists, to what you look for. Do you think we're going to see their earnings expectations slowly catch up to yours as well?
That's exactly right. And I think it's really for two reasons. We thought the S&P could do $75 in earnings in 2010, which was considered an outlier number at the time. And our thought process at the time was that, hey, financial earnings just need to get to about $11 per S&P share, which is worse than they did in 2002. Now, we're starting to get a little more optimistic about 2010 earnings because the industrial recovery looks like it's going to be stronger. And as you know, if you have industrial production ramp up 10%, companies are going to see some really big earnings revisions on the heels of that. So, we do think analysts and strategists really need to raise their numbers for next year. And, in 75, I think, is very achievable for the S&P.
And what's the level you're looking at? I mean, 14 times earnings you're expecting at the end of the year. That's not historically very high, but it's not also historically low.
That's right. If someone was looking at this as a secular bear, from 2000 to 2007, we've seen a multiple collapse in the markets. So in order for the second, as we think about the second half, the next 5 years or so, I think it's really going to be an earnings story. So we're thinking 15 times 75, that gets you around 1,100.
All right. Hey, Tom, thanks so much for joining us today. Tom Lee there, Chief U.S. Strategist at JPMorgan Chase.